management teams, entrepreneurs are decidedly preferring private capital.
So I'm looking forward to talking to Jason Thomas today. He is the head of global research and investment strategy at Carlyle, but he was also once the director of policy at the National Economic Council.
Even if you believe the destination is a public listing, it's coming so much later.
We're going to talk about rising correlations across stock and bond markets, risks that are seemingly brewing in public bond markets today that are making people consider private markets more and more. Welcome to the latest episode of The Bridge by iCapital. I'm Sonali Basak, the Chief Investment Strategist at iCapital, and today we are joined by Jason Thomas. He is the head of global research and investment strategy at Carlyle, a global asset manager with almost $500 billion in assets under management. Jason has a unique view of the world because before Carlyle, he had worked as the director of policy at the National Economic Council, so has long taken the macro from a policy perspective as well as a markets perspective and brought it all together for us. So he's going to do that for us now. Jason, thank you for joining us.
Thanks for having me.
You know, when we talk to our clients, there is one problem that really topples all the other problems that they have, which is that they feel that their portfolios are increasingly concentrated. And this is something you've written about a lot. What role in particular do private markets play in the concentration problem? Do you think it helps bring people into a greater degree of diversification?
Oh, absolutely. But I think the important thing to understand, when we look at over the last 20 years, private markets really started as a barbell, which is to say it was early stage venture, it was late stage LBOs, lots of delistings. And over that period of time, everything's been filled in. And as what's happened over that period is really yesterday's growth stocks, promising companies, very attractive growth trajectories, different industries, have really gravitated to private markets. So there's now about 4 times as many companies in the United States backed by private capital than there are publicly listed companies. And again, it's not just that there was some pro rata shrinkage of the public markets. It is precisely those younger, faster growing businesses that have migrated. So today, I don't think that the diversification we used to take for granted in the stock market is possible without a fairly sizable private markets allocation.
You recently wrote about this in the context of SpaceX, saying really that SpaceX was a continuum of this trend. What changes now? I mean, if you fast forward the next 5-10 years, you're watching these companies go public later and later in life at bigger and bigger valuations. What does that mean in terms of the role of the stock market in an investor's portfolio?
It comes much later in a company's life, if at all.
Right, true.
So when you think about Amazon, when it went public, it was 3 years after its founding. And it was precisely in that kind of donut hole that existed at the time where it needed additional capital for growth, needed some liquidity for the founders. And the only option at that time was a public listing. Today, companies don't really ever have to go public if they don't want to. So 15, 16, 22 years, of course, in the case of SpaceX. Secondly, what we look at in the recent paper is the importance of disclosure. And this is really, when you are a fast-growing company today, it's very likely because you have some proprietary technology, maybe it's a new way of doing business, maybe it's just your unit economics. And you really would like to keep that private for as long as possible until you attain the scale to find yourself in a different competitive position. You don't want to provide a template for your competitors to essentially expropriate your ideas or move into your market. And that's really significant. And what's interesting is that when you look at life sciences companies, so companies that have to file a patent to disclose their invention, to secure the patent monopoly, they actually go public at the same age today as they did 25 years ago. So I think that kind of proves, that's the exception that proves the rule, you could say, because they've already had to disclose this information, that they're willing to go public. Companies that can actually protect their secrets until they attain a scale go public now about almost 5 times later in their life than they did 20 years ago.
Interesting, a competitive advantage to being private in a lot of ways. You wrote that it's not that public markets are broken, but they are changing what it means in terms of price discovery, idea incubation is what you wrote,
Yeah.
and allocative efficiency. I thought that was one of the most important ideas here.
Yeah, I think in each of those, first, when you think about SpaceX or some other upcoming potential large IPOs, everyone's talking about index inclusion. So now passive vehicles that match indexes essentially account for 2/3 of the liquidity that's being directed at private markets. So when you're just buying stocks on a pro rata basis to replicate an index, there's no real price discovery there. Idea incubation, again, just this idea that the companies with this proprietary technology, younger businesses, remaining private. So that's something that is gravitated out of public markets. And then third, the allocative efficiency, that's where you look at the concentration. AI stocks today accounting for over 40% of the S&P 500. Just the top 10 stocks in the U.S. Stock market accounting for a record share of the total. But it's a bit different than it was in the past. In the past, the top 10, you could have concentration, but they were in retail or oil and gas, pharmaceuticals. Today, 8 of those 10 businesses are essentially in the same sector, 7 of them pursuing the same strategy. So again, your allocations, your much more concentrated exposure to a single risk factor than had been the case in the past.
It's interesting. That's an argument a lot of people make, that the stock market has always been concentrated, but there are reasons that it's more concentrated today than before. You made this point. I think what you were going to say is that 2/3 of flows go to public equities passively. Is that what you were?
No, exactly. So I'm just suggesting that when you think about the price discovery, it used to be that index funds were a great way to give people participation in the stock market whose values, the prices, were actually being set by informed investors, essentially trying to arbitrage mispricing away, pulling prices back to fundamentals. Today, it's the index funds that are actually setting prices to a much larger extent because those flows of passive investors in stock markets are actually dominating the flows of the informed investors.
So it's interesting when you think about the reason private capital has been contributing to portfolios so much for the amount of investors who actually do invest in private assets, right? We know that a lot of individual investors don't have access at this point in time or have not gained access. What does it mean for companies that can grow from the beginning of their life cycle to year 20 or 22 in the case of SpaceX? You call it information economics. You got to some of these ideas before in terms of why a company has an advantage in that pre-IPO timeframe. But what are you actually getting? I mean, how much value is being accrued?
Oh, well, now I think you're looking at about twice as much of the lifetime value for a company that goes public is now accrued during the time when they're private. I mean, SpaceX, just the most recent example, when you think about going from zero to $1.775 trillion, that was entirely in its life as a private company. And look, it's traded up. It could trade back down. There's going to be some volatility ahead. But when you think about all of that had been accumulated while it was private. So again, just going from 3 years, a median age of going public 25 years ago, to 15 or 16 years, the median age today, that's essentially a doubling of the total value that's going to the private investors.
So Carlyle recently looked at what would happen if you shifted some of a traditional 60-40 away from just public equity and public debt. And if you took 80%, if you had an 80-20, 80% public credit to 20% public equity, and shifted it to become 60% public credit and moved it to 20% public equity and 5% each to private equity, secondaries, private debt, and infrastructure, you looked at what the portfolio outcome would be. And some of that was a higher cumulative return, a higher annualized return. But one of the more interesting things to me was that the drawdown was actually much better, meaningfully better, if you did make those shifts. How much is that a consideration in portfolio construction, just weathering bad times?
Oh, I think that's really central, right? So you're thinking about two things with diversification and looking at private markets. Well, 3 things you could say. First, obviously, the higher absolute return. Second is the volatility drag, that you want to lessen that. So you're compounding more effortlessly over time. And then third, in those bad states of the world, when there is the drawdown, how much has your portfolio been impacted? So again, you want to maximize your return. That's how you get the extra 200 to 300 basis points. Secondly, the volatility drag being lower. The portfolio variance is falling through the private additions. And then third, as you reference, you also have better experience in those bad states of the world. And it's important to note that this is actually looking at ex post what had happened. What we've found since 2022 is that diversifying role that public credit, particularly high-grade sovereign bonds, have played in the past, providing very reliable offsetting deviations for stocks. And this was a period of time when you had QE. So as soon as the stock market had a drawdown or the economy hit a rough patch, you knew that the Fed, other central banks, were going to launch another round of QE, drive yields down, send their prices higher. Since 2022, it's actually the opposite. Stocks and bonds have moved in tandem. The three drawdowns that we've seen over the past 16 months, Liberation Day, whatever happened with Greenland, those concerns, and then, of course, March of this year, you had the 10-year Treasury falling almost proportionally to the S&P 500. So I think that many of the results that we've seen in these drawdown periods in the past, where private allocation outperformed a portfolio that did not have private assets, actually understates the extent to which there would be greater drawdown protection going forward.
It's interesting. Of the top concerns we hear from clients, one of them is certainly the concentration risk, but another one is that rising stock bond correlation. Mm-hmm. And if we think about it, it's interesting. The Council of Foreign Relations recently wrote so far that this could be a systemic risk in a lot of ways too, because you would experience a drawdown in both ways. How many people are actually looking at private markets to mitigate that potential concern?
I think it's the top of what investors are looking for, and also commodities. The difference, so commodities also provide the diversification. The problem is that there's no return, there's no current yield. You're just essentially making a bet on the commodity price rising in those bad states of the world, or at least being uncorrelated, so that its trajectory is going to be quite different from that what you see in the stock and bond markets. Private markets provide the uncorrelated aspect to a large extent, but then also the current income if you're in private credit, or actually just the return, the value accrual. And so I think, again, it's commodities, it's private markets, but that is an important distinction.
Now, I want to go back to what we started to talk about here in this part of the conversation, which is the bond market, because this has played out to be a very interesting year. A lot of questions about the trajectory of inflation. What do you think about this sort of higher for longer world that we're living in now and the feed through across asset classes?
Well, I think that first we have to appreciate that in normal times, 2 or 3% inflation, what's the difference, right? It's measurement error. This is close enough. 3% inflation, 100 basis points above the Fed target, coming on top of a 25% increase in the price level, as we've experienced since 2021, it's almost like salt in the wound. It's just to have prices continue to rise at a faster pace, given the recent past, is problematic. What is your top complaint? Top complaint about the current environment is the price level, is inflation. And I thought that in the first press conference, Chair Warsh made it very clear that inflation is a choice and the inflation is unacceptable. And also, it was not the excuse of the Iran war, the closure of the Strait of Hormuz. It was references to the last 5 years of excess inflation. And so I think that markets have taken from that things are going to be less predictable. There was a time when everyone thought we're on a glide path to base rates of less than 3%. Now there's much greater uncertainty about what the future holds, and rates where they are today, may be with us for much longer than we thought. Of course, there's potential of even rate hikes, as we get toward the end of the year, depending on where some of these other prices go. And so I think what this means for asset allocation is that this focus on assets with very attractive terminal values, very often software, for example, those assets are very highly leveraged to the level of interest rates. Anything where it's not the current cash flow, you're actually buying an asset whose most of their free cash flow comes outside of the underwriting window, is again going to be sensitized to rates in a way that companies that are generating a lot of current income are not. And so I think there's a lot of focus today on duration, which is to say, how much free cash flow is a company generating today? And that as a way to reduce its sensitivity to interest rates and reduce the sensitivity of the overall portfolio to rates. And so, when you think about, you can look at payback period. How many years does it take for a company's current free cash flow to fully amortize the purchase price? Well, in the case of software, at the start of this year, it was over 200 years. So it gives you some sense because, again, you're paying 12 to 15 times sales, or you're paying 35 to 45 times EBITDA, or you're paying 200 times, in some cases, free cash flow. That's the implication of that. And that's why this focus on AI and disruption in software, everyone talks about the terminal value. Well, why would that be? That's because that's where all the money is arriving outside of that 10-year underwriting window. So I think this has really changed the way that people are thinking about different sectors, different types of companies. It's a period of digestion. Digesting the sense that rates are not going to converge. It's taken a long time. 2023, people thought rates would fall as fast as they rose. And then sort of stuck with us, And then, of course, the new administration, lots of expectations there would be very significant rate cuts.
Yeah.
It's just still digesting this.
It's interesting. It's funny to hear you talk about duration risk because it feels to me that this period of AI uncertainty is causing people to really tighten duration.
That's right.
You hear people in the credit markets talking about not being able to underwrite past 5 years, let alone 3 years sometimes. And what does that mean in terms of the trade-offs that investors are making? Are investors more comfortable taking on credit risk because duration risk is becoming less attractive?
No, I think that what's interesting is when you think about owning a 10 or 30-year bond, just longer maturity. The question is, you are taking duration risk. You're taking the volatility. Are you going to get inflated away? What sort of interest rate movements can you expect? How is the price of that bond going to respond to all that? And you find that people were not getting it all compensated for it. Again, this was the QE era. The duration, the term premium, essentially went to zero, or it was negative based on some measures. So you're getting no compensation for lending to the government 10 to 30 years. And I think as now people are more sensitized to that risk, the volatility of bonds. If rates go up, as people just saw again last Liberation Day, what you paid $100 for your 10-year bond, it was worth $94 12 days later. Right, that's a big fair value loss for something you're not really getting very much coupon interest to hold.
Yeah.
So the alternative is to take a zero duration asset, essentially something priced off of SOFR, 90-day money, and then the incremental spread comes from the credit risk you're taking. And so when you're getting compensated 4, 5, 600 basis points for the credit risk, as opposed to getting virtually nothing for the duration risk, you see that a much better way to generate incremental income is to assume credit risk rather than the duration risk, lending, again, mostly to a government or a corporate at much longer maturities.
This crunch on longer-term government financing has pretty meaningful ramifications. I'd love to talk to you about it in terms of what it means for certain strategic assets, defense assets, for example, where the fiscal spend is really meaningful to defense. Anything that requires more government spend to facilitate infrastructure spending, which is an enormous need in this country, let alone many others, where we're seeing longer-term yields really take off through the course of 2026. What role does private capital play in terms of these giant build-outs? Because this seems like a mega force that really can't be ignored.
Yeah, I think that one of the lessons of the last few years is really that there is we've compared GDP across economies, thinking about NATO's GDP, comparing it to Russia's GDP, it's order of magnitude larger. But I think people have become more sensitized. It's not just GDP, because things like royalties on McDonald's franchises, that's real income, but it's not quite the same thing as manufacturing production capacity. So if you look at real productive capacity, real industrial capacity across economies, you get a very different view of things. China's economy is about the same size as the United States in purchasing power parity terms. U.S. economy is larger than China's at market exchange rates. But if you look at real productive capacity in the industrial sector, China's economy is almost 4 times larger.
And they've made a lot of investments as well.
Enormous investments. And so I think that sort of distribution is something that has a lot of people uncomfortable.
Yeah.
And I think if there's one thing to bet on over the next 10 to 15 years, it's that the distribution of global industrial capacity is going to look very different in the future. And that's because of the scale of investment that's going to occur, certainly in the United States, certainly in Europe, but also in Japan and other economies. And because of the fiscal constraints, because of how indebted most of these economies and governments are, the only way to effectuate that reallocation or the reindustrialization is going to be through private capital. And I think that the interesting thing is how that private capital gets mobilized over the next, again, 10 to 15 years to facilitate that. Very interesting discussions in Europe right now, savings and investment union. Of course, the United States, more developed private capital market that I think is more ready to step in and do so, pretty expeditiously in concert with the government with, some additional spending. Japan, it's the same thing. A lot of that is on the exchange rate, making it more attractive to invest, more cost competitive to invest in domestic industrial capacity, of course, also doubling their defense budget. This is, I think, really central to the longer term horizon. We're thinking about what are, given the scale of uncertainty, given the technological disintermediation, what can we really count on happening? I think this is central to that.
Yeah, when you think about private markets more largely, I think one of the interesting things about what's going on, it's not just about, an individual investor's portfolio and changing some of the allocations to fit the realities of market structure. Some of this is macro. The way you've put this to me in preparation for this conversation is that it's mobilizing savings.
Yeah.
The Europe example seems to me like one of the most obvious ways of this risk transfer that you're describing.
Yeah, so I think that the issue that's identified in Europe is that you have more savings in absolute terms in the United States, a higher savings rate, but actually much lower returns on that savings than you have in the United States. And the question, why is that? It's because 4 times as much of the savings is channeled into the banking system. And that's a problem because the bank balance sheets just don't have the same risk-bearing capacity as private markets. They can't take risks on earlier companies, companies with, where you're really not sure. They have potentially very discrepant growth profiles, investing in new technologies. Also just the duration of the cash flows when the company actually moves in to a positive free cash flow position. And so having a financial system that's so bank-centric just means you're actually starving ideas and entrepreneurs of capital. And I think that is something that is really a focus. How do you take, again, a larger base of savings, but that channel it into more productive uses? And I think that they recognize that private capital is the only solution. And I would just say that what has been most interesting over the last 10 years has been watching Japan and the way that it has focused on mobilization of private capital, but also to actually invigorate a market for corporate control, to actually force delistings because they realized that companies would be more productive if they were in private hands, to encourage spin-offs because different divisions of companies would be more productive if they were in private hands. It's almost as though public policy in Japan was really aligned with invigorating the private capital market. And it's had an enormous success when you look at the performance of that economy today relative to where it was a decade ago. So I think the Japan template is one that Europe can look to, and I think many other economies as well, as something that when you invigorate these markets, when you mobilize the savings, good things happen.
Yeah, I'm wondering what you think that comfort with the private assets comes from when it comes to savings products, right? I mean, if you think about it, you and I were talking about this earlier, that the insurance landscape has long invested in private markets for a very, very long time, really. And so so when you think about this movement into more individuals getting into private markets, really, to me, the only difference is the liquidity as well as understanding the vehicles themselves. But structurally, there's kind of nowhere else to go but private, given how much the market is expanding across the globe.
Yeah, I think, again, we spend so much time talking about the supply side of capital, that new funds being formed, evergreen vehicles, different strategies. But ultimately, the growth of private capital markets is about decisions made by founders, entrepreneurs, and management teams. And if they prefer to access private capital to grow or for liquidity for founders, then it means that the rest of us have to actually change our portfolios so that it comports with this new investment opportunity set, which is inevitably moving in the private direction. So I think that's really, it's very simple. It's not people being forced into private markets or having no choice. It's that this is where the investment opportunity set has gravitated. This is where it's turned. And you have to change your portfolio accordingly.
So to that end, one of the areas where you've seen a lot of investment from the private side is artificial intelligence. We talked about SpaceX, but obviously Anthropic and OpenAI going public in 2026 has really drawn a lot of questions about what role private equity, venture capital has played, but also data centers, an enormous amount of private capital going into data centers all across the energy food chain as well when you think about these build-outs. I mean, what is the AI consideration here when you're thinking about this from an allocator's perspective? We started talking about concentration risk. Realistically speaking, AI is pervasive, right? So how do you access it in ways that make sense for the future, to future-proof your portfolio realistically?
The question really for me is to how do you make sure that you have exposure without AI consuming all of your incremental risk budget? Because it was interesting talking to allocators at the end of 2025, and when they looked at real estate, when they looked at infrastructure, certainly the public stock portfolio, most obviously, they realized that actually almost all of their incremental risk budget was consumed by AI. So again, this was a sense that they're very bullish on it, desiring exposure, but realizing they had to have some sense of prudential risk concentration limits. And I think that is the big issue. It does in many ways show what can be accomplished when you mobilize private capital, just in terms of the scale of investment, the speed with which it's happening. To me, the most attractive place to access the opportunity is very much on the energy side. And that is also electrical equipment. But when we think about the energy demands, the energy needs, the growth of the energy consumption of data centers, that to me is the key choke point. And it's also when you think about energy transition, when you think about the demands on electricity for electric vehicles, this is something where we know that there's productive use for the capital. In some cases, there's a fairly wide range of outcomes. So if you're investing in a frontier AI lab, for example, the speed of change is so rapid that there's a lot of volatility there. You're accepting a lot of risk. In the energy space, it's of course needed for the data centers. It's needed to power the future of the technology, but it's also something that has a very much an embedded need, particularly as it relates to, again, broader electrification. So to me, the risk reward is probably most attractive in that space. And when you're thinking about in those relative allocations and in terms of what's exposed to AI.
Right. Is that how you truly find diversification? Just trying to find things that would really live on in a meaningful way despite the AI theme?
I think that one of our best investments of recent years was a company that we knew had exposure to the semiconductor value chain, and it was really related to lithography and it related to testing chips. But the core business was actually medical devices. So it's really like these are the perfect diversification opportunities because you have a great business that has this very dedicated demand as it relates to medical devices and equipment, but it essentially also embeds a call option on AI and semiconductor demand. So I think it's those kinds of investments when you think about like where can I get this convex upside in this good state of the world as it relates to AI, while also having a business line, an underlying business that I know is going to be time tested and consistent no matter what happens with the technological revolution we're in the midst of.
Right. Are there really investments now that are kind of AI proof, or do you think it touches everything?
Well, I mean, it's your view on robotics, right? I mean, there was a period of time where people were talking about how software was going to be disintermediated, business services was in trouble, so you really needed to focus on areas where you still needed the human labor or that it was in the physical world. But if you believe that there's going to be 80 million humanoid robots in relatively short order, well, you could say that nothing is fully AI proof. And that's why I think it comes back to this idea of duration, that the more cash your asset generates today, the shorter the payback period, the less you have to be right about the future of technology 5, 7, 10 years into the future. And that's why, as you mentioned, that duration in the underwriting and just writing down or assigning higher discount rates to cash flows or terminal values further into the future, that's just a part of the world we live in right now, given the speed of change.
I do find more institutional investors these days are talking about duration risk as it pertains to the government bond market. And it does lead to the question, well, wait a minute, are people looking at government bond duration differently from how they're taking on duration and risk in private portfolios?
So when you talk about duration or interest rate risk, it's of course a fixed income concept. And I think we were living in a world where people didn't even realize that duration risk applies to everything. And it was only the interest rate shock and the downward move in valuations of some of the long duration assets, again, kind of growth software, that people said, oh, I didn't realize that this also was exposed to the same risk as the government bond market. So I think, again, it's digesting that. It's understanding that, yes, the fixed income concepts are really just about how sensitized the market value of an asset is to a change in interest rates. And as interest rates have moved up and as uncertainty has increased in the out years, and whether it's because of concerns about solvency from a fiscal situation or speed of technological change as relates to other sectors, it exacts the same impact on the market values, and you have to incorporate that into your underwriting accordingly.
Do you think, though, that, just back to the government bond market, because it had been such a big part of investor portfolios, do you think that the comfort with such high traditional fixed income allocations will start to erode?
Oh, I think it has already. I mean, when you look at who is the largest buyer of Treasury securities today, it is a hedge fund sector, but it's doing it as relative value trades, but especially basis trades. So it's borrowing generally 18 times or more, cash bonds, coupon notes, and then selling it forward in a basis trade. And that's why, of course, the Fed had to intervene at the end of last year with the reserve management purchases to make sure that the short-term funding for the financing leg of these trades didn't have any volatility. That was the borrowing costs are almost precisely at the Fed funds interest rate. So I think that you've seen, of course, foreign investors, reserve managers they haven't really been selling, but they haven't been adding to their exposures. And then you have much of the rest of the market that has just been a little weary of adding to their exposure, particularly seeing the amount of debt that is going to be issued on a prospective basis. Over the next 12 months, the U.S. Treasury has to refinance over $10 trillion of maturing securities. And, I think people are not so sure about the interest rates that are ultimately going to be carried on the coupons that these securities are going to carry. And, when you look at what is maturing, it generally has relatively low coupons. I mean, these were things issued before the pandemic. So you have, on average, notes that are 3.2% interest rates now being refinanced into 4.5%, maybe 5%. So I think that this just sort of wanting to wait it out or find alternatives to the bond market is something that's very real today. And I think that sense is only going to grow over time.
No, I would completely agree with you. And if you think about the feed through, just quickly, what are the ripple effects? Higher for longer, shorter term and potentially longer term interest rates. What are the asset classes in your view that are most impacted by that?
It is this sense that when you look at assets with this terminal value, and this is like the whole year since the Anthropic shock from Claude Code, since the analysts on Wall Street have started to uniformly cover the frontier AI labs, there's just this sense of, oh, software is going to be disintermediated. And then everyone started talking about software being priced off of its terminal value. And it's like, this is just accepted as fact, terminal value. The only reason software is priced off of terminal value is because on average, the amount of current income generated, again, the free cash flow today is so low. So it's not that this software is just priced off of terminal value. It's simply that the valuations got so high that the cash flow relative to enterprise value is so low that the payback period extends so far into the future. So I think that this is an issue with, even if you believe that many of these software companies are going to incorporate AI, going to be able to fend off these rivals, even if you have a very optimistic case, and I believe that, by the way, it still doesn't mean that you're going to rescue the valuation because of the upward adjustment in bond yields, the change in attitudes about interest rates. And I think it's going to just focus attention on some of those assets. It was even something like internal combustion engine auto parts, right? People thought internal combustion engines were going away. So they thought that companies that made parts that were exclusively for the ICE value chain were essentially going to disappear. So the value came so low that you can actually underwrite some of these companies, generating so much cash over 5 to 7 years to fully repay your cost basis and generate a 20% annualized return on top of that.
So you've mentioned software a few times. Software is one of the concerns around private credit.
Sure.
Right? It's all as an industry at large. Also, this higher interest rate environment provides some really interesting ramifications because on one hand, a lot of private credit is floating rate. And so in theory, higher for longer would be good for forward-looking money in the ground today. But at the same time, it would mean that the borrowers are sitting under higher interest rate burdens. What's the trade-off in your mind on private credit in this environment?
When you look at the software businesses, I think that the credit risk is this existential risk. Do you think software is going away? And as I said, I don't really believe that's true. We did a survey of our management teams in the first quarter, and we looked at, again, the AI spending is enormous. IT budget's growing about 28% year over year. So what are you intending to do with this spending? How are you financing this spending? Hopefully it's not just coming out of EBITDA. And interestingly, number one was growth strategies, that in the future, there's expectation of being able to increase your revenues with less headcount than would normally be associated. So, you could think about a division of a company that has 200 open but unfilled positions, maybe that would be reduced to 100. And the expectation is by leaning into AI, you can achieve the same growth with less hiring than would have been required previously. Secondly, there is the relationship with consultants and how much is being spent on consultants. There is some belt tightening there on a go forward to some of the savings. Third, it's actually a lot of IT systems that remain on premises. Very little has gravitated to the cloud over the last 5 years. So as you move to these cloud-based AI-centric architectures, you're actually saving on your on-premises maintenance spending. And very low on the list was software. In fact, only 12 of 104 companies that were surveyed suggested that there was any intention of reducing their software spend. So it's kind of interesting.
Very contrary to the conversation.
Exactly.
That's
So
happening.
I think if people talk to the management teams that are actually spending on AI, that are really trying to ensure their company is far out on the technology frontier as possible, they would realize there's actually less risk to software than I think is commonly supposed.
So it sounds like you're less concerned about software and the impact on the private credit industry.
Exactly. It's an equity problem. Because it's just the entry multiples were much too high. The entry multiples were calibrated for a world of essentially zero base rates indefinitely. And I think so it's interesting that I think the market has, again, the software worries, 20%, is it 30% of the portfolios in private markets, software, and thinking that this is a private credit problem, when in fact, it's an equity issue. And I think for equity, it's also not necessarily zeros or bad outcomes in an absolute sense. It's just that this is where all the returns were for many years. 30, 35% net IRR, software exposures that today, some cases, if you purchase something in 2020, 2021, 2022, getting out, recovering your full cost might be a good outcome. So I think that, again, separating the two, and in those cases, since the credit is senior, first to get paid in any transaction, they're going to make out just fine, getting out at par, getting their accumulated interest. So again, I think it's an equity issue. As it relates to, higher for longer rates, I think that these rates today are just not that high. Base rates at 365, 375 is actually kind of a sweet spot because it provides a base yield to the creditor, but it's also not so onerous on the borrowers, most borrowers that don't have especially leveraged capital structures. So I think that it's good for creditors, to get 500 basis points on top of that. And then also when you look at the change in fund flows, right? This is now a market where the fund flows have reversed. So now it's moving from a market where there were more lenders than borrowers, you had a lot of downward pressure on spreads, to one where actually spreads are widening. Your risk-adjusted returns are getting more attractive each quarter.
So all of a sudden, the environment's actually getting better for private credit at a moment where a lot of investors have tried to turn away.
Exactly. And that's, I think, the pro-cyclicality of fund flows in the market. I think we need to appreciate that. So right now, I think, if current trends continue, by year end, you're going to be looking at extraordinarily attractive credit investment opportunities. The flip side of that, some of those marginal borrowers are going to have a bit more difficult time refinancing. So
rates will be higher.
And just, probably wider spreads and also just more conservative underwriting. You see these changes already, and if these trends continue, you'll just see that the creditor will just take a more conservative view of the enterprise value of a company. The creditor will not be as willing to move to payment in kind. They'll demand cash interest. There'll be tighter covenants, and there'll just be terms that will be a little bit more onerous for the borrowers. And then again, those borrowers at the margin are going to have a more difficult time refinancing. So I think that's the change. But again, from a private credit perspective, things look very bright.
Last question for you. I can't help myself. We're in this new era for the Federal Reserve. The day we're taping this, it's the same day that Alan Greenspan passed away. He turned 100 years old and passed away above 100 years old as we're watching Kevin Warsh take over the Fed and really potentially unwind a lot of the things that we saw during the Greenspan era, arguably. What's the most profound thing that investors should really keep an eye out for in the new Federal Reserve?
I think that we had crisis era policy that was understandable and in many ways absolutely necessary. That just became normalized. So you had policies that were appropriate for a crisis that were pursued during a more normal era. And what I think, number one, of course, is the size of the Federal Reserve balance sheet. But number two is forward guidance. So forward guidance was a way to say, hey, you're expecting us to move much sooner than we intend to move. And some of these, 5 to 10-year interest rates look much higher than we think they should be based on our expected policy path. So we're going to communicate more with you about the direction of rates. We're actually going to buy a lot of bonds to put our money where our mouth is. And we hope that you're going to actually believe us. And then the financial conditions will ease in proportion to, again, what we're telling you and then what we're doing with our bond purchases. And, it's not so obvious why we need that today, right?
It's a different era.
And you have this issue of a hall of mirrors where the market is supposed to be there to tell the Fed something about what they expect for inflation, what they expect for what level of interest rates is appropriate, how they're digesting new information. But if the market is just pricing things based on what they expect the Fed's going to do, all of a sudden, that informational component of market pricing that the Fed should rely on to help set policy is gone because the market's just reflecting back what the Fed says it's going to do. So I think that this new era is actually trying to move back to what existed really prior to the crisis, where you're going to, I think, presumably reduce the size of the Fed's balance sheet. We'll see how much and at what speed. But then also really kind of get rid of forward guidance. Let the market sort of make its own judgments about what level of rates is appropriate. And then the Fed can actually incorporate that into its own thinking. So I think we're moving from a crisis policy that was pursued in normal times to actually how things used to exist.
So does that spell more volatility for the bond market?
Oh, I don't think there's any way around that. And it's not just the bond market, it's the forward rates. When the Fed was very clearly and conspicuously telling you what it intended to do, what it was telling you what they thought the neutral rate or the terminal rate was, you had forward interest rates, the forward curve for SOFR, that was, again, really calibrated to exactly what the Fed was suggesting or intending. Now I think there's going to be quite a lot of choppiness to that. As new data come in, whether it's inflation or output or employment, there's going to be the market has some more freedom now to assess what that means. And I think there's going to be quite a lot of volatility ahead. I don't think it's a market that is ready for this. The Fed has been holding the fixed income market's hand for so long. This is like dropping a child off at kindergarten, and waving goodbye. And, there can be some tense moments, some crying. And I think that's what we expect to see.
Well, to think back to the Greenspan era, the Greenspan put, you could argue that this is a market that's been addicted to that put for decades now. How are investors going to wean off this idea that the Fed won't necessarily step in anymore every time there's an issue?
Well, I think this is the lesson from the COVID crisis. You had obviously a public health crisis. You had this enormous decline in employment, huge contraction of the economy. No one knew how long or how deep it was going to be. And so what did the Fed do? What the Fed has always done, massively intervene. That massive intervention also came with a statement of its long-run policy objectives in August of 2020 that essentially said they would tolerate above target inflation going forward to make up for past inflation shortfalls. At that time, everyone expected zero base rates, basically for the next 5 to 6 years. And that, I think, is also what allowed for a much larger fiscal response to COVID. Not only did you have the $2.9 trillion that was spent in March of 2020, right as the pandemic really took hold, but another $900 billion in December of 2020, followed by the $1.9 trillion package, the Recovery Act, in March of 2021. So the Fed, with this, massive easing, the expectation of the Fed put, any problem, massive intervention, unlocked a chain of events that ultimately culminated in a 25% increase in the price level. The constraint here was always inflation. And it's when people worry about the government not being able to pay back its borrowing, that is going to manifest at a higher price level, higher inflation, and again, higher bond yields needed to protect you from being inflated away. So I think that what we've learned now is the Fed, the scale of the intervention going forward, has to actually now be constrained because I don't think anyone, given how upset, again, the electorate is about inflation, about the price level, is going to tolerate something like this happening again.
Jason, I'm excited to be following this next year with you. Certainly, it could get choppy, like you said. That's Jason Thomas of Carlyle, and you've been watching The Bridge by iCapital.